Alright guys, so here I'm to teach you the borrowing and leasing. Either we borrow to buy the asset or we lease the asset. Yeah. So this question is from the ACCA September December 2019. That is Dinks. So the requirements say for the new machine, I calculate the net present value of the cost of borrowing to buy. So you have cost of borrowing to buy. Okay, so we bold it. So we bring our years, and from the question, Dinko would ideally like a 4-year loan. So it is a 4-year project. It is a 4-year project. So you bring your years. So year 0, year 1, year 2, year 3, year 4. But as I said in my earlier lectures, when you are doing investment appraisal questions, there has to always be an additional year because you don't know all the information in the question. So yeah, it is having an expected life of 4 years, but you have to add an extra year in case there's any information that will require you to input a figure in the year 5. So you just bring year 5 also. That's all. So starting your investment appraisal question is very simple. You just have to bring your initial outlay, or let's say the cost of the machine let's say cost of the machine, right? So the cost of the machine, so it will be a year 0 figure, which is supposed to be negative. But here Dinko is a small company that is finding it difficult to raise funds to acquire a new machine costing $750,000. So the cost of the new machine is $750,000, which we are going to borrow to buy that asset under the borrowing side. So negative $750,000. $750,000. Now, reading the question say Dinko would ideally like a 4-year loan for the full purchase price at a before tax interest rate. We will come back to that later, but let us continue reading. The machine would have an expected life of 4 years. At the end of this period, the machine would have a residual value of $50,000. So the machine will have a scrap of $50,000 at the end of each year, which is year 4. So $50,000. Tax allowable servicing cost for the machine would be $23,000 per year. Tax allowable servicing cost for the machine will be $23,000 per year, which is very simple. So now, if there is supposed to be a tax allowable servicing cost, meaning that there is a servicing cost, meaning that there is a servicing cost of 23,000, which they paid throughout the useful life of the asset. They say that tax allowable servicing cost for the machine would be 23,000 per year. So there's a servicing cost of 23,000 per year. So we have servicing. Servicing cost. Let's do servicing. So year 1, which is negative $23,000. To year 4. That's another borrowing to buy. You have the servicing. Now, the question says that tax allowable depreciation on the full purchase price would be available on a 25% reducing balance basis. So all this information here are associated with the borrowing, because the next paragraph says that a leasing company has offered. So this one will be the note II. So now all these are for the note I. So the note I says that residual value is 50,000. We have it here. Servicing cost, which is 23,000 per year, and there's a tax allowable depreciation on the full purchase price, which is 25% reducing balance. So now we have to calculate first for the tax allowable servicing cost. And the question says that Dinks Co pays corporation tax of 30% 1 year in arrears, meaning that they pay tax the following year after the tax has been incurred. So if they incur a tax, or if they have to pay a tax in year 1, or if they make profit in year 1, their tax for year 1 is going to be paid in year 2, and the corporation tax rate is 30% in arrears. So finding those who have done FC's taxation, you know, allow and disallow. But for the sake of those who haven't done it, it's very simple. The servicing cost, you allow some for taxation, meaning that the full amount that you pay, you have to less tax from it, so that the amount you pay will be lesser. Let me put it that way so that you understand. So always the tax allowable or the tax allowable depreciation is to reduce the amount of tax. So we have our servicing TAD, tax allowable depreciation, which is 30% of the servicing cost. But here the question says that it is paid 1 year in arrears, so it will start from year 2. So 30% multiplying the year 1 figure, not the year 2 figure, because it is the year 1 figure that you are paying the tax in year 2. So multiplying the year 1 figure, but this is supposed to be positive, so you negate it again to give you a positive figure. Then you drag it to year 5. That's all. The reason why we are dragging it to year 5 is that it is having a useful life of 4 years, and now it is paid in arrears, meaning that year 4, which is the end of the useful life, the amount that we had, the tax is going to be paid in year 5. Even though there is no operation, I am going to pay that tax in year 5. So we bring the tax allowable depreciation here. But when you are solving for cost of borrowing, you don't pay tax. The tax is adjusted for in the interest rate, or the interest rate that you use for the discounting. So we don't add a column of taxation. There's no taxation here when it comes to borrowing to buy and leasing. There's nothing like tax. So now we have our original TAD. They say that tax allowable depreciation on the full purchase price would be available on a 25% reducing balance. So we have reducing balance TAD. We have reducing balance TAD. Now let us set up our workings. So our workings. So year 1. So the TAD, the TAD, which will go here. So let's bring year 1, year 2, year 3, and year 4. So here are your workings. So here is the rate, which is 25%, and here is your reducing balance rate. The reducing balance rate is 25%, and your tax rate, the tax rate is 30%. With the tax rate, it is 30%. Now, tax allowable depreciation on full purchase price. On full purchase price, the purchase price is 750,000. So the cost or the asset balance is the 750,000. 750,000 here, everything, and here is the depreciation. Here is the depreciation. Reducing balance is very simple. It is the same as financial accounting and financial reporting. Reducing balance. So here is the depreciation. So now reducing balance is equal to the asset balance multiplying the rate of depreciation. Here is it, 25%. So equal to the asset balance multiplying 25%. We drag it to year 3, not year 4, year 3. Don't worry. Now the asset balance becomes the asset balance in year 1 minus the depreciation. Remember, it is reducing balance. So the asset balance minus the depreciation will give you the asset balance for the following year. Yeah, that's it. Then you drag this one to year 4. After dragging it to year 4, there was a scrap value in the question of 50,000. 50,000. So the remaining figure will be this minus the scrap. So this is your depreciation figure. This is your depreciation figure. That's all. Now your TAD is now these figures, the depreciation figure multiplying the tax rate, which is 30%. So it is true for all to the 4 years. That's all. Very simple. Very simple. So these figures will also be positive figures. And remember, tax is paid in arrears. So since tax is paid in arrears, it will also start from year 2, not year 1. So you just place them here. That's all. You just place them there. That's all. So you now have your total amount. So you just sum all of them. Mind you, the tax allowable depreciation is the same procedure for financial reporting when it comes to the reducing balance method. We also have the straight line method. It is the same thing. The initial cost minus the scrap value divided by the total number of years. It's the same thing. It's the same thing. So you don't have to panic. So after getting those depreciations, you just apply the tax rate. So after getting these depreciation figures, this won't go to your answer, but rather you apply the rate which is 30% on it to get these figures. So these figures are always positive, and that is what will go into your main answer. So you have to set up your workings to show the examiner what you have done. So the asset balance, you apply the reducing balance rate 25% to get the depreciation. You drag the formula here up to year 3. So this year 4 figure, you have to less the scrap, because it is after year 4 that we sold it, and we don't calculate depreciation on scrap. So you have to take the scrap out of the asset balance as of year 4. So the remaining becomes what was depreciated in year 4. That's very simple. So you set up your workings in thousands from year 1, year 2, year 3. And mind you, year 0 is always for the initial investment, initial capital. But in this case, you are borrowing, so it will be cost of capital. Cost of capital. So let's set up our rates here. So here we have our before tax rate, which is 8.6%. We have our tax rate, which is also 30%. And also, sorry, so after setting up this, you bring your reducing balance rate, which is also 25%, right? This question is from the Kaplan. That is September, December 2019. A sample ACCA exam question from the Kaplan. Dinks School. Very tricky question. So now we have everything here. So what we need is our net cash flow. Our net cash flow. So the sum of everything here, from the cost of the machine to the real TAD. You just drag it here to year 5. That's all. Now you bring your discount factor. Now the discount factor, a lot of students will make mistake and bring the 8.6, which is wrong. They say that the loan for the full purchase price at a before tax interest rate. Those who have done F6 taxation know that it's supposed to be an after tax rate, but it is not for you to know in financial management. All what you need to know is to just adjust this 8.6% or allow it for taxation, and it is very simple. So you see these workings I have set up here. We have the before tax per the question, which is 8.60%. We have the tax rate, and we have the reducing balance rate. But we won't touch the reducing balance rate. We won't touch it. So now our after tax rate our after tax rate will be equal to the normal tax rate, which is 30%, multiplying bracket open 1 minus the before tax rate, which is 8.6%, which will give you 6%. So the normal tax rate, which is 30%, times which bracket 1 minus the 8.6%. Oh. Sorry. The after tax will rather be the 8.6. That's the before tax, multiplying the tax rate, or 1 minus the tax rate, 6%. Yeah. Again, adjusting it for tax is the before tax rate multiplying bracket open 1 minus the tax rate, 30%. You are taking the tax out of it, 6%. That is what you use for your discount factor. So your discount factor is also equal to 1 plus the 6% exponent negative the number of years. That is raised to the power the number of years. You drag it to your 5. Four decimal places. So now your present values will be discount factor multiplying the net cash flow. That's all. So now your NPV is the sum of everything here. This is your NPV. Your NPV, that is 597,269. That's the NPV for the borrowing. Now we have the leasing. We have the lease. We will have years. So 0, 1, 2, 3, 4, 5. So with the lease, the question says that a leasing company has offered a contract whereby Dinks would have to use the new machine for 4 years in exchange for an annual lease rental payment of 200,000 payable at the start of each year. So the annual payment is 200,000 payable at the start of each year. So the payment, the lease payment, $200,000, which is a negative figure. Up to year 3. So 1, 2, 3, 4. Up to year 3. Payable at the start of each year. Year 0, year 1, year 2, year 3. It is having 4 years. You have the payments or the lease rentals. Now, the question is saying the contract states that the leasing company would undertake maintenance of the machine at no additional cost to Dinks, meaning that the organization that will lease the asset to Dinks will do the maintenance themselves without Dinks incurring any cost. So there is no cost of operation. So at the end of the 4 years, the leasing company would remove the machine from the maintenance. We remove the machine from the manufacturing facility of Dinks. Dinks pays corporation tax of 30% 1 year in arrears. So we have to also allow this for tax, the lease payment for tax. The reason why we are allowing it for tax is because we don't pay tax when we borrow or we lease. We don't pay tax. And the tax rate is 30%, which is payable 1 year in arrears. So in year 1, they are going to pay it in year 2. So the 30% tax rate, multiplying the year 1 figure, which is 60,000. But it's supposed to be a positive figure, so you negate it again. You give a positive figure. Now you drag to year 5. So that is all. This one, we don't own the asset, so these workings we don't need them. The depreciation we don't need them because we don't own the asset. We haven't bought it. We are leasing it. So this will become all the figures that you need. So now your net cash flow is the sum of everything here up to year 5. That's your net cash flow. Now from your net cash flow, you use your discount factor. The before tax rate was 8.6%. 8.6%. Our tax rate is 30%. So our after tax rate is the 8.6% multiplying bracket open 1 minus this 30%. which is 6%. So our discount factor is 6%. So equal to bracket open 1 plus 30%, 30% exponent negative the number of years 0. We drag it to year 5. So present values, discount factor multiplying cash flow. So your NPV is equal to the sum of everything here. And mind you, everything is supposed to be negative. Everything is supposed to be negative. Everything is supposed to be negative. That's all. That's all you need to know about the leasing and the borrowing. So you have to make it 4 decimal places. 4 decimal places. Okay. 4 decimal places. And you add all of them. And that's your answer, 463. And so the question says that recommend which option is more attractive in financial terms. So leasing, you are going to have to pay 463,000. Borrowing, you have to pay 597,000. So meaning that it is more advisable to lease than to borrow. It is more advisable to lease than to borrow. So we lease the asset. We lease the asset. State that we lease the asset. That's all. We lease the asset. So that's all about the borrowing and the leasing. My next lecture, I will touch on the equivalent annual cost, EAC. Also very simple. Please subscribe to my channel.